Hey everyone, my name is Daniel and welcome back to the Finance Channel. I hope all of you are having a great day out there. As always, here today, I want to talk to you all about SmileDirectClub, and I want to give you all an in-depth analysis into exactly what the company is, what they do, their balance sheet, their business, and furthermore, dive deep into the numbers and analyze exactly whether or not SmileDirectClub is potentially an opportunity here over the long run. So if you end up enjoying this video and potentially finding some value in it, please consider subscribing. And without further ado here, let's get into it. So before we dive deep into any of the numbers, I just want to take a look at the stock here. SmileDirectClub rather, just under $7 per share. And I mean, this stock has been absolutely decimated ever since their IPO back in late 2019. And that's just a bad time to go public. I mean, sure, they got a great valuation and whatnot, but they went public right before COVID. And as we can see through revenue, which I think Yahoo Finance does show here, the business got pretty much destroyed during COVID when it comes to actual revenue growth. This was a ridiculously fast growing company prior to COVID with revenue anywhere from the triple-digit percentage range to anywhere from 70%. So a ridiculously quick growing company. Went into the public markets immediately after, experienced COVID-19, doctors' offices shut down and whatnot, leading revenue to kind of decline substantially. And alongside that, they recently went off of a cyber attack where luckily no data was compromised, but those things paired together have led to this stock experiencing a significant downtrend ever since their initial public offering. Now, this begs the question: is SmileDirectClub worth it as a stock, as an investment, which is the question that I hope to answer in this video. So first and foremost, we have to understand what the heck is SmileDirectClub. We can see that, SDC, ticker symbol SDC, they participate in the clear aligners market. So this is, if you ever heard of braces, correcting your teeth, your smile, it's essentially, potentially like an invisible clear aligner that goes ahead and fixes your teeth. I'm not a dentist or an orthodontist by any means, but at the end of the day, I had braces when I was smaller. They worked, but a lot of people or a lot of kids around me, they used clear aligners. They used Invisalign, which is the dominant player in this market share, Align Technologies, with a market cap in the tens of billions of dollars of range. But looking at SmileDirectClub here, they're in a very similar space, but what they're trying to do is leapfrog the orthodontist kind of aspect of it, where that's kind of the place that, Invisalign or Align Technologies focuses in on. They're trying to go direct to consumer. We can see with their, pricing here, their different products. They go ahead, they send this kind of package to you. You put your teeth inside of it. That gives them a bit of a kind of like a shaping and whatnot. They send you aligners on a regular basis. Either you pay monthly or upfront, and hey, your teeth get fixed. I have, kind of asked, fellow orthodontists and dentists that are friends of mine about SmileDirectClub, and, they said it's great. It works, but at the end of the day, they are in kind of competition with orthodontists, again, trying to leapfrog that process. Now, SmileDirectClub, the thing about this business, again, this is a significantly fast-growing kind of sector that they're operating within, expected to grow just under 30% annualized over the next 8 years, leading into 2028. So if we look at SmileDirectClub, even if they manage to potentially just be the number 2 player, there is significant opportunity for them to, really grow their revenues in a massive, massive way. Now, the next thing I want to focus in on here, and this is really important to understand, a big change is coming to SmileDirectClub's business model, and I want to just go full screen just to show you exactly what this change is. Over the past, I want to say, ever since they went public, over the past few years, SmileDirectClub has been focusing a lot of their funds, a lot of their energy, and a lot of their team on growing their business from the perspective of revenues, offices, new products, etc. But what we've seen is because of that, there was a major loss on the bottom line for the company. Now, hey, although that's great, they grew revenues, at the same time, they were unprofitable. So what the business is doing now, obviously we can't operate at a major loss over the next 3-5 years, or else the company is going to either dilute shareholders in a massive way or potentially go bankrupt. So what management is saying is, hey, we're going to switch up the way we do business. And I actually have this visualized here from their latest earnings call. I just want to make sure I have this all right here. They're kind of going for roughly 20 to 30% revenue growth here over the next 3 to 5 years. And at that same time, spending less money on marketing, and because of that, they expect EBITDA margins to go from anywhere from 25 or to go from, a negative EBITDA right now to anywhere from 25 to 30%. Now, is this possible? Yes. Is it probable? That's the question we need to ask ourselves. Well, when we look at the company's actual income statement, which is what I want to do here, when we look at their income statement, this is from their latest quarter, we can see that they had roughly $188 million in revenue. This is actually growth year over year from 2020. Total revenue just under $200 million. But either way, cost of revenue is sitting just at in and around 50 million. So 75% gross margins at this company. Look at the biggest cost. The biggest cost is clearly marketing, with over nearly $100 million in marketing spending over just the past few months, January, February, and March of this year. Now, you can already see them kind of transitioning into this phase of potentially less growth, more profitability. Again, this is not the growth of the company. This is a ridiculously quick-growing company. We're still in COVID. Once we exit out of that into the back half of the year, growth will begin again for this company moving forwards over the next 5-10 years. But either way, marketing is the biggest, positive but negative at this company. And here's why. When I talk about SmileDirectClub, almost everyone that I talk to knows exactly what it is. Why is that? Because of this marketing spend. They have spent so much money on marketing that a lot of people know about SmileDirectClub, and the brand recognition is there. So from that standpoint, I think they did a great job. And I think that potentially scaling back on the marketing a little bit will not actually impact the business in as big of a negative way as some might imagine, because there's already that brand recognition, so you may not need as many ads. They've already kind of done that. Now, potentially even reducing some general administrative expenses. But either way, I see a path for this company to reach 20 to 30% EBITDA margins over the next 5 years if they put their energy into that like they're saying they will. Focus less on revenue growth, which will come naturally. They expect 5 to 7% a sequential quarter-over-quarter revenue growth over the next 3 to 5 years. And on top of that, because of that less revenue growth, less spend on marketing, more profitability. And that's what I like to see as an investor. A profitable business is always a safer one. Now, when we look at the balance sheet of this company, we can see that total assets totaling just around $1 billion. Roughly 700 million of this is current assets. Again, I want to say just over 600 million, 650 million in cash or accounts receivable. So money that is easily accessible. When we look at their current liabilities, totaling just around 170 million, they could pay off all of their liabilities, nearly all of their long-term debt. So not that big of a problem with this company, especially if they start transitioning to more of a profitable company that will help reduce a lot of that debt over the long run. So I'm optimistic from what I'm seeing here with this net income statement, from their plan, from their balance sheet, from the business model. All green flags for me right now from what I've seen. So now that we understand the business, the potential, again, I have seen some advertisements, them expanding into potentially teeth whitening, which hey, there's a lot of opportunity here in the dental space for them to expand into beyond just clear aligners. But we have a bit of an understanding now as to what the business is, potentially some of the fundamentals. Let's dive deep into the potential. What is the potential of SmileDirectClub as a stock? What is potential revenue growth, profitability, valuation? Well, I want to go through all of this with you right now. And what I'm going to go through is, first and foremost, a bit of a base case scenario, then we'll go through a bit of a bear case, and then we'll go bull. So I'll show you guys 3 different possibilities, each of which will outline some of the potential opportunity here with the stock. Now, I did make this presentation a little bit ago. I just want to make sure SmileDirectClub is trading. I think it has moved up a little bit since then. I have $6.67 here right now. Yeah, it's trading at around $6.90 at this point. Not the biggest deal in the world, but hey, let's change that. Let's get a little bit more accurate, by the way. So either way, they're expected to do roughly $833 million in revenue in 2021, or at least this is what analysts and I believe company guidance actually shows. Now, moving forward here, I'm going to expect revenue growth of roughly 25% over, again, the next 5 years, moving into 2025. Now, this is a kind of in the middle range when it comes to the company's expected revenue growth of anywhere from 20 to 30%. Now, keep in mind, we'll go through some different scenarios in a moment here, but 25%, highly achievable in my opinion, given the substantial revenue growth we've seen over the past 5 years. Again, since the company's existence, 25%, I think that's fine. Now, what about the EBITDA margin? Well, the company expects to hit a 25 to 30% EBITDA margin at some point over the next 5 years. Now, keep in mind, I do have this red here when it comes to net income throughout 2023 because I don't expect this company to start showing, significant profits until the back half of the next 5 years, which is, again, that's kind of let me restart here. When I look at a company, when I look at a stock, and I really like to picture it from a long-term perspective, anywhere from 3 to 5 years out. So if they're not profitable throughout 2021, 2022, I frankly don't care. All I care is that this company will be profitable at some point over the next 5 years. And I think that is a good mentality to have as a long-term investor. Now, an EBITDA margin, this is earnings before interest, taxes, depreciations, and amortizations. Depreciations and amortizations, these are pretty much non-cash expenses. So, in reality, it's just interest and taxes that do pile on to this. So again, $500 million in EBITDA, using, again, that $2 billion revenue number in 2025 could be conservative. But either way, assume a tax rate of just around 23.4%, which is what Align Technologies pays. Add a little bit for interest and other expenses, roughly 6.4%, and you get potential net income of just around $350 million 5 years from now. So again, that is substantially higher than what we're doing here today. In fact, it's infinitely higher because the company's actually at a loss. But either way, this gives us roughly a 17.5% net income margin, and using a PE ratio of 25, you multiply net income by this PE ratio, you get a potential market cap of just under $9 billion. Now, the current market cap, from my understanding, is close to $2.6, $2.7 billion. Hey, maybe even price in potentially some dilution here as the company transitions to, again, becoming more of a profitable company. They may, again, incur some expenses here over the next year, assume maybe some dilution to maybe 450 million shares outstanding. You still get roughly a 3x over the next 5 years here, assuming a rather conservative base case scenario. Now, this is obviously the base case. Let's look at the bear case. When I look at any stock, I always want to look at the worst case scenario because this lets me prep for all situations. If we still have upside potentially for some of the base case, or rather bear case scenarios, that's considered a margin of safety. Now, let's assume roughly 20% revenue growth over the next 5 years, leaving the company with just around $1.7 billion by 2025. Again, revenue growth won't be difficult for this company. In my opinion, what will be is EBITDA. How much profit are they going to be generating off of each dollar in revenue? Well, in this case, I'm going to use roughly a 20% EBITDA margin, giving us just around $345 million in EBITDA by 2025. Now, tax rate stays the same. Interest and other expenses, hey, you may even want to, let's raise this a little bit. Let's go 8.4%. Heck, why not? $235 million in net income using a PE ratio of, let's say, close to 20, you still get upside of just around 76%. So you really start to see that, hey, even if this company doesn't hit their targets, which in my opinion, revenue is almost definitely at 20%, EBITDA margin, let's maybe decrease this to 18%, you still have that margin of safety that says, hey, if things go wrong, you are more likely than not going to lose money over the next 5 years. Now, again, I'm not a financial advisor. I'm not a wizard. I can't tell you what revenues, profits, EBITDA, and valuation are going to be at 5 years down the road. But if I can look at a bad case scenario and I can still picture myself making money throughout that time, I mean, you're still kind of beating the market here at 10% returns over the next 5 years using this bear case scenario. That makes me optimistic because that's a margin of safety, and whatever happens beyond that, that's a great thing. So obviously, this is just the base case and the bear case scenario. Let's go through a potential bull case scenario. What if things go great and exactly according to plan from what management has said? Now, before we keep going here, I do just want to put this into perspective here. Management has said that they expect anywhere from 5 to 7% quarter over quarter growth in terms of revenue over the next roughly 5 years here. Well, if we take, let's say, $1 in revenue, increase that by 7%, 7%, 7%, and 7%, essentially showing us, a potential yearly growth rate, this gives us roughly 31% growth throughout every year. So when I kind of talk about this number here, again, in this case, 7% translates to 30%. They're a kind of conservative scenario of roughly 5% growth. This gives us revenue closer to roughly 21% revenue growth. So you see, I'm still being a little bit conservative here using their estimates, but let's assume the positive scenario. 30% revenue growth, 30% EBITDA margins, which is what the company has been expecting. Let's take this down to maybe 5.4%. Let's assume a valuation a little bit higher, maybe 30. Align Technology is trading well over 40, so why not? It's a company growing significantly, and you get a potential price upside of roughly 5 to 6x. So is this going to happen? I want to make myself very clear. I'm not telling you this is going to happen. I'm just saying it's a possibility, and not just that, it's a pretty dang likely possibility as long as management executes. Well, if they don't succeed on potentially becoming more of a profitable company, that's just the company being a company. Sometimes things work out, sometimes they don't. They personally think they'll succeed in changing their business model to accommodate more profit for shareholders, and in this case, again, potentially a 30% EBITDA margin, which is something like Align Technologies, right around that level. So will SmileDirectClub achieve this? Maybe. But even if they don't, you do have that margin of safety to where, hey, even if they don't hit 30% EBITDA margins and maybe get 18, 17, 15% EBITDA margins, you still have that long-term potential with this stock to not lose money on your investment. So that's my opinion on SmileDirectClub. I think there is a lot of opportunity here, which is why I am going to be adding it to my watch list just to kind of look at here over the next little while here. It may be one of the next stocks that I buy, given my understanding of the business model and the value proposition that it kind of shows us as investors here. Let me know rather what you think in the comment section down below. But I think SmileDirectClub presents a very nice opportunity, and if you're someone willing to buy this stock, I'm not stopping you. I think it's a great company, great opportunity, minimal risk with a lot of upside. Anyways, thank you all so much for watching. I really appreciate you being here. If you found some value in this video, please consider subscribing, and I'll see you all in the next one. Bye-bye.